ARIS in 2025 has started to become known throughout the swap world as one of the markets that can actually influence the swap market because of very large blocks. We've had a string this year of dozens and dozens of 5,000 lot block trades, 10,000 lot block trades. Swap desks and other participants of the broader swap market have to pay attention to, even if they're not trading it, because it can start to affect activity and pricing in the swap market. When it comes to asset managers and those who maybe are not as margin sensitive, the real advantage of ARIS just comes in the operational simplicity, the same reason that people like trading Treasury futures over cash Treasuries, for example. ARIS is a forward starting swap in a futures form, so unlike traditional par spot traded swaps, it's the same product today, trading today that was trading yesterday. Users are easily able to see a transparent price pre and post execution one day after another and not have to go look up a certain QSIP or value something in Bloomberg to get a price for what they want to trade.
What is the history of Eris Innovations?
ARIS started as Eris Exchange back in 2010 and started as its own futures exchange, clearing futures at CME Clearing. Over the years, it evolved into an intellectual property licensing company where CME took over the product. At the time, ARIS LIBOR swap futures in 2018, shortly after we got a patent on the product and licensed the product to them. And then in 2020, CME launched ARIS SOFR swap futures based on the same underlying methodology that allows futures to have the cash flows of an interest rate swap. So we, Eris Innovations, have continued to partner with CME to help develop the market for ARIS SOFR swap futures, which have grown significantly since they were introduced in 2020, and then especially since mid-2023 after the LIBOR market ended, which combined the ARIS LIBOR and ARIS SOFR liquidity pools into sort of one product. And then especially important in the growth of ARIS SOFR was the implementation of portfolio margining between CME swaps and ARIS SOFR swap futures, which really unlocked liquidity from market makers who were able to provide almost boundless liquidity to buy-side users who were looking for a capital-efficient alternative to an interest rate swap. In 2018, as CME was taking over the ARIS LIBOR swap futures and Eris Innovations was becoming a intellectual property licensing company, we did have a DCM, a regulated DCM, which spun out from Eris Innovations and formed its own company, recapitalized as a cryptocurrency exchange, and was eventually sold to CBOE Global Markets, which runs it as CBOE Digital today.
What are the drivers behind your recent success?
Things really started in 2023 to pick up in the ARIS SOFR product because of portfolio margining, making it a lot more efficient for market makers to hold CME swap positions against ARIS SOFR positions. And so what you have now is a situation where buy-side end users who want swap exposure are able to hold ARIS positions very margin efficiently and have about 65% less margin posted for a given level of risk in swaps futures than they would in swaps. While on the other side, you have market makers able to carry those positions market risk neutral by offsetting with CME swaps, but then at almost no margin because of the super efficient margin efficiencies offered at CME. What that's led to is rapid adoption by a number of end users, with two main categories of end users who are building open interest, building the large open interest holders numbers at the CFTC, for example. The first is those who don't have good access to the swap market because they're maybe not covered by Wall Street, or they're not very well covered or have expensive access to swaps. But the second and main area of growth we've seen in the last 2 years is really among traditional swaps users who have started to move into using swap futures in a more wholesale way, replacing core positions with capital efficient swap futures. So like if you go into public filings, for example, for some of these large real estate investment trusts, for example, you'll see that over the course of 2025, they've just systematically put more and more of their swap positions into swap futures, building core positions that lead to open interest and, of course, to volume. We also have a product that rolls on a quarterly basis where you have the option to roll or to keep it and allow the product to go off the run. And so even the roll volume, of course, that people are familiar with in TradFi futures is alive and well in Eris as well, contributing to ADV.
What impact did LIBOR's end have on Eris SOFR futures and rate hedging?
The first is that for a while, the world was living in a bifurcated structure in which there were people still trading LIBOR, there were people adopting SOFR. And I would say the take-up of SOFR swaps, and especially ARIS SOFR swap futures, was somewhat held back by people holding on to LIBOR as long as they possibly could. And so when people were forced out of LIBOR end of 22, mid 23, and had to put all their eggs in the SOFR basket, that really accelerated growth quite a bit in the ARIS product. The second thing, which is perhaps a little bit more subtle, is that SOFR as an index compared with LIBOR has standardized swaps that are built on an overnight index swap structure. And so there's just the translation for end users is that there's a lot less risk to be had from trading a delta bucketed position. You can trade a quarterly SOFR future for ARIS and not have to worry about the same reset risk that you had with the 3-month LIBOR. In 3-month LIBOR as a term rate, if you had a very specific date that you needed to hit in order to have a LIBOR fixing for your customized swap that aligned with your bond interest payment, for example, you had to be sure to hit that exact date. But with SOFR, because all of the vanilla swaps in SOFR are overnight index swaps, it's all averaged out over a period of time such that trading a quarterly contract just doesn't involve anywhere near the basis risk that LIBOR did.
How has portfolio margining influenced participation?
For end users, the key has always been that they can get efficient access to swap risk with a lot lower margin, not because of portfolio margining per se, but because futures have 1-day value at risk based margin as opposed to 5-day minimum value at risk margining for swaps. The key has always been what sort of liquidity is available in ARIS, and so that's where portfolio margining has played a significant role. The first thing it did was allow proprietary trading firms who have access to the swap market to be able to have more efficient access to be able to carry positions in ARIS without having to have a large bid-ask spread at the start. So that compressed bid-ask spread, which made even more buy-side firms want to trade in it. But then what's happened is volume has steadily risen from the buy-side demand. It's actually attracted dealers into the market, traditional swap dealers who are making markets in ARIS block markets on CME from their traditional swap desks. I mean, literally they will take an inquiry from a client over a Bloomberg IB chat window, for example, and say, do you want that 10-year swap in ARIS form or do you want it in swap form? That has really been a catalyst for our growth because, of course, no one has better access to the swap market than the dealers themselves. And so when they're willing to lean on swap markets in order to provide liquidity in ARIS, it really is a multiplier in terms of our liquidity.
What is driving the growth of ARIS Treasury swap spreads?
One of the great things about ARIS SOFR swap futures being listed at CME and on CME Globex is that CME is able to link the order books of various products together through what they call intercommodity spreads or through spread order books that are connected with implied functionality. One of the most popular trades in the swap ecosystem is swap spreads or invoice spreads when they're traded of swaps against Treasury futures, especially at CME. ARIS Treasury swap spreads are essentially the intercommodity spreads on Globex between ARIS SOFR swap futures and CME Treasury futures, which allows for no execution risk trading of spreads between, say, the UXY, the Ultra 10-year Treasury future, and the ARIS SOFR 10-year. These are traded in futures price. These are cleared at CME. You can do algorithmic execution and essentially get swap spread or invoice spread risk in a futures form, trading with a variety of market participants and being able to go in and out and add to your same position day after day.
Which new ARIS features or markets are being explored?
The big story in ARIS of the past couple of years has just been growth, volume, open interest. The underlying futures product that we have listed at CME today is growing significantly and is able to support new users. We are working with CME in product development in order to do what I would call logical extensions of futures markets in the form of new products in 2026. Not really allowed to say exactly what we have planned here, but not hard to guess, I would say, given the setup. We consistently have market participants asking us for new tenors, new products, new ways to trade this. Certainly exposure to nonlinear risk exposure is one of the largest requests we get, and we look forward to working with market participants on some developments coming soon.
How might the planned 2026 collaboration with CME influence ARIS's future growth?
CME runs ARIS SOFR swap futures. They are the lister of the product and they are in charge of its roadmap. We collaborate with them very closely on development of future products. And we're excited that we have some things to announce here in the coming months. The growth of the ARIS underlying markets has led to considerable activity and ideas from market participants from a variety of different sectors about what could be next in the product life cycle.